I'm with Andrew Canter in his office here at Futuregrowth, and we've been talking about a section or Regulation 28.
Regulation 28 of the Pension Funds Act. What it is a set of regulatory limits, of risk limits for pension funds in doing their asset allocation and investments. So, for example, you can't have more than 65% of your fund to equities, for example, in a retirement fund.
So that you can't lose it all or not lose too much of it.
It enforces diversity, and sets limits on things like international assets and property investments and such. Yeah.
Now, you were explaining to me how this works and how the allocations go.
Right. So I think the key concern is the limits as relates particularly to the banking sector. With the collapse of Able, what we've learned is that actually banks are actually quite risky animals, as if that shouldn't be a surprise, but for some reason it was. And the problem with Regulation 28, and by the way, this applies equally to the unit trust regulations, where they allow quite high exposures. Under Regulation 28, which is supposed to be a set of limits, maximum exposures, you can have up to 25% of your pension fund exposed to any single bank in South Africa. 25% of your fund, that's a big number.
So you could have had that in Able,
absolutely. Not even just in Able subordinated debt instruments. That's a scary thing because those things have been wiped out, of course. And furthermore, you could have up to 100% of your entire pension fund, your entire retirement scheme in the banks of South Africa. There was functionally no limit on bank exposures.
So we're learning from global financial crisis, from Able, and things are going to change.
Right. So Reg 28 was revised now 2 or 3 years ago, and what we found now with the evolution of banking regulations and now the Banks Amendment Bill that we need to change Reg 28 is the headline. We need to reduce those risk limits per bank and per industry.
In what way and when might that be brought in?
Well, okay, so this is just the beginning of the debate. I mean, Able just happened a few months ago. You need to get the FSB on board, you need National Treasury on board, you need SARB on board, then there's going to be a discussion with the industry, but I don't think it's a long way off. I mean, I would hope that this would happen within 12 months.
Is it just you thinking this way?
Oh, I don't think so. I think when the Reg 28 limits actually were introduced, many of the institutional investors said they were too high, and we kind of agreed as part of accepting that we had other fights to fight at the time. We said, okay, just leave it there. None of us are going to apply that limit anyway as rational institutional investors. Bear in mind, not all the money being managed is by rational institutional investors. We wouldn't apply it, so we didn't fight that battle. But I think we're ready now to reactivate that debate with particularly the FSB, who looks after Regulation 28.
Making savings safer for people who are putting their money away.
Yeah, well, that's the intention, of course. I mean, if an institutional asset manager had been using those limits in an Able, they would be facing, their pension funds would be facing some serious problems right now.
Andrew Canter is with Futuregrowth.